Welcome to Bloomberg Technology. I'm Emily Chang in San Francisco. Stocks extending a rally after a very volatile session. Huge surges in big tech with Apple, Amazon, and Facebook all spiking on the back of earnings. Alphabet, on the other hand, ending the day in the red. This as President Trump is considering a plan to order a change in ownership for the social media sensation TikTok. The app is owned by a Chinese company, and now Bloomberg has learned that Microsoft is in talks to buy TikTok's U.S. operations. Now, across the United States, cases of COVID-19 continuing to rise, but at a slower pace. Florida reporting record deaths for the fourth day in a row. And as of today, the $600 unemployment checks millions of Americans have been getting will expire. Next week, the benefit drops to $200. Joining us to break down how investors are digesting all of this are Abigail Doolittle, who's been with us all week long. Abigail, got to talk about this big tech rally for everyone, it seems, but Google.
Yes, a huge rally for Apple, Amazon, and Facebook, especially Apple, but Alphabet, Google, the odd stock out. Now, of course, yesterday you and I were talking about these earnings reports, really strong blowout quarters for most of these companies. Apple in particular, it's interesting, the stock had been up, let's call it 5% for most of the day. And then in the afternoon, right around the time that Microsoft TikTok news came out, Microsoft actually reversed because that stock had been down about 2%. And that's when Apple simply took off. It was almost as though there's an invisible hand behind Apple surging this way. It's hard to believe that institutional money is buying this stock. The valuation at a 5-year high, up in a huge way. They haven't provided an outlook, but nonetheless, great results from Apple, Facebook, and Amazon, each of them beating estimates. In fact, Apple and Amazon both meeting or beating the adjusted earnings estimates prior to the pandemic, so almost as though they had never been reduced. Facebook, not as much, but nonetheless, investors relieved that their ad sales were pretty strong. Not the case, though, for Alphabet. They saw not as much strength of their ad sales. In fact, revenues declining for the first time ever, so that stock down about 3.3%. All of this, of course, Emily, did lead to some record highs for Apple and Facebook. We did see record highs, not just on the day, but right on the open. Really pretty impressive. That was not the case for Amazon, Alphabet, or the NASDAQ 100. But nonetheless, it is a nice feather in the cap of investors, shareholders of both Facebook and Apple to leave this week, this month, this period of volatility with more record highs, Emily.
As the clear winner of the day, then, Abigail, is Apple surging more than 10%. They also did that for one stock split, which we touched on. Big beat on earnings. People are still buying devices, iPads, Macs, and iPhones in the middle of this time. Why do you think Apple is surging so much, though, given the valuation metrics here?
Yeah, it is pretty interesting because when this stock took off later in the afternoon, it was a bit surprising to me. Again, it almost felt as though there was just this invisible hand swooping this stock higher. Technically, very overbought, popping above a channel that's been reliable over the last decade. I think a piece of it, a lot of folks are starting to say this is a consumer staple stock because of the strength of this iPhone sales during the pandemic. The fact that they were able to put up these very strong numbers. They beat revenues by 11%, Emily. They beat the adjusted earnings estimate by 24%. And again, that actually met what was prior to the pandemic. Services grew, I believe, by about 13% year over year. So, just strength right across the board. And folks want in on, one of the biggest companies in the world, best managed or one of the best managed. And frankly, when you have some stocks in other areas not doing as well, some of the cyclical areas, such as the Caterpillars and the energy stocks, that money seems to be going right into big tech. Another piece of it, though, you did mention that stock split. Now, this is their fifth stock split in history. The stock has had a history of doubling relatively, periods of time after that stock split. Back in 1987, that was the first one. It took 147 months to double. level, so quite some time. But more recently, after the stock split in 2005, it took less than 2 years. The 2014, here we are at a stock split. And some of this does make the stock a bit more friendly to investors, retail investors in particular, I should say, because instead of buying, a stock that's a few $100s higher, they'll be buying one that they think is cheaper, even though we know that it's not. But just the optics of it makes it a little bit easier for that retail community to get in. In fact, some analysts are recommending Amazon do that. Instead of having, this $3,200 stock, you could have a stock that's trading at, say, 500 or 600, perhaps a little bit more appealing, again, to the retail investor, Emily.
Right. Absolutely. This definitely makes it more achievable for retail investors. Okay, Abigail, thank you so much for joining us there. Moving on to the story I mentioned earlier, the president hatching a plan to order TikTok, the parent company, the Chinese parent company of TikTok, to sell its U.S. operations. Joining us now from Washington, Bloomberg's Naomi Nix, who's been covering this story. Naomi, what exactly is the president considering here, and how is this really within his power?
Yeah, it's been an interesting day for TikTok. So essentially, Trump and actually Secretary Mike Pompeo said earlier this month that they were, considering doing this in part because of in retaliation over and it's how they've been blaming China for that. But it's not clear exactly what Trump's planning to do. The Committee on Foreign Investment, which is the government entity, which includes Trump administration, had already been reviewing ByteDance's purchase and ownership of and Trump's Federal Trade Commission. They were doing TikTok's data privacy practices. And so this was already under scrutiny by the Trump administration. And so, whether we would have seen some movement out of those two efforts more quickly, could be possible. It sounds like that plan might be on pause because Microsoft has emerged as a leading contender to buy TikTok's U.S. operations, which might eliminate some of that regulatory pressure.
So let's talk about this. As this story was breaking, this other story that Microsoft is in talks to buy TikTok broke. Obviously this is, I assume, good news for TikTok. How would this help the company?
Well, for starters, it removes that regulatory pressure. We had previously reported that ByteDance had already been considering selling a majority stake in its U.S. business because of these regulatory threats. Not only the Trump administration, but lawmakers in Congress had been, raising questions about whether, the ownership, the company represents a national security risk to U.S. interests, and whether the company was compromising and potentially censoring Americans, on the app. And so I think it relieves a headache for them and also helps them, depending on what the price is, get a good financial deal.
Interesting, though, what this would mean for Microsoft. Obviously, for years, Microsoft is trying to get a foothold in social media. It is one place that they haven't dominated. That said, the CEO of Microsoft, Satya Nadella, has said it's going to be an enterprise-led company going forward. And it's curious to wonder how that fits into that overall strategy. What would this mean for Microsoft?
I think, for starters, it gives Microsoft an in a very young and potentially lucrative audience, given the young age that this age group that this app is popular with. I also think it gives Microsoft access to some artificial intelligence technology that it might find useful and maybe gain more insight into consumers' habits in a way that, say, Microsoft's LinkedIn does not currently provide. And it's also likely not an accident that it's Microsoft considering this, given that's the one major tech company that's not currently under antitrust scrutiny in Washington. And so, Microsoft has a longer runway here to make a deal like this.
Right. Though you do wonder if it's going to trigger some regulatory scrutiny. Microsoft, of course, does own LinkedIn, which is a different kind of social media, certainly not as consumer focused, but something that we are going to continue to follow. We'll have more on that story later in the show. Bloomberg's Naomi Nix, thank you so much for giving us that update. Meantime, coming up, tech stocks following an earnings blowout. As we mentioned, Apple, Amazon, Facebook, all seeing huge surges. We'll talk about what's behind those moves next. This is Bloomberg. Diving into big tech's big day yesterday into today, I want to look behind the reaction to the earnings reports of the big four tech companies. Dan Morgan of Synovus Trust is with us. Dan, I want to start with Alphabet, given that it's the only one of these stocks in the red today. And obviously looking at the massive contraction in the global ad market, but it's something that Facebook hasn't seemed to have felt the effects of. What makes Alphabet different or in a different position than Facebook?
Well, you're right. When we look at the four stocks that reported earnings last night, Google is the only one that's really down. And I think what the street is really focusing on is, even though ad revenues came in at $29.87 billion, they're above expectations. But if we look at the percentage changes from, let's say, a year ago, down 8.1, and over from the last quarter, down 11%, we compare that to Facebook, on the other hand, which also beat expectations at $18.3 billion, but they also had an increase of 10% year over year in ad revenue. From a quarterly basis, they were up 5%. So if we're trying to kind of compare and contrast the numbers, let's say, between Facebook and Google, I think we'd have to really zero in on those ad revenue numbers, because Facebook exceeded expectations and is still continuing to grow year over year and quarter over quarter, where Google, unfortunately, is showing negative growth from the first quarter and the same second quarter a year ago. So I think the street was a little bit focused on that, and that's why we saw good performance from Facebook and we saw Google down.
So talk to us about what is driving the decisions of advertisers, though, because Facebook's in the middle of this massive ad boycott. It's been happening this month, so we will probably see the impact of that in the current quarter, not in the quarter that was just reported. But we know that more searches are happening on Amazon, for example, and not Google. What are the trends sort of behind the scenes that might be impacting where advertisers are putting their dollars?
Well, you're right. I mean, we heard the news a couple of weeks ago that quite a few customers of Facebook, because of concerns about hateful language and so forth on their website, were going to boycott spending money for advertising revenues. And one thing we have to take into account is exactly, well, what does that mean? If we took the top 100 customers for, let's say, Facebook, they would only represent roughly about 1% of the total top-line revenues. About 76% of all Facebook customers are small players, small, not huge, Fortune 500 companies. So I think that's something that, a lot of people are concerned about. As you just said, it hasn't quite all impacted yet. It will going forward. But as you mentioned before, Amazon is also becoming a bit of a player in the ad space, and they are kind of eating into Google's space, as you mentioned before, in terms of search. So, we're starting to see some overlap in a lot of what these companies are doing in terms of the different areas that they're focusing in. But I think the fact that Facebook had such good numbers, that kind of defied some of those concerns about the boycotts and so forth.
How successful has Facebook been in monetizing the other platforms, monetizing Instagram, and, of course, WhatsApp?
Yeah, I mean, that's a big thing. That's huge for them going forward in terms of huge growth driver. I mean, WhatsApp is really something they really haven't done a lot in terms of trying to monetize. I mean, that's a huge area of growth for them going forward. And, when Facebook was getting all the bad news about the Cambridge Analytics and so forth, a lot of people don't know that they, like you said, have Instagram, they have WhatsApp, they have Messenger, and they have all these other huge platforms where they have tons of subscribers, and they're just now slowly starting to move forward in terms of monetizing those. So those are huge growth drivers going forward, especially WhatsApp.
Let's talk about this rapidly emerging social media threat, though, and that is TikTok, which, of course, is in the crosshairs of the U.S. government. But now this headline that Microsoft is in talks to buy TikTok's U.S. operations. What do you make of that?
Well, it's huge. We think about Microsoft as a company in a lot of ways like Apple. They have a tremendous amount of cash on hand. You were talking earlier about LinkedIn and the acquisition they did there. That got them into kind of the business, area. But now you're kind of expanding out into a market they really don't have a tremendous amount of exposure, right? Because we think of Microsoft, we think of their presence in terms of maybe gaming and on the enterprise and Azure and the cloud. But we don't think about them as a company that has, any real exposure to, let's say, the small, in terms of young people. We think of Snap and so forth. So I think this is a good move for them if they can, get it to go through, because it's going to give them exposure into a market that they really don't have much of a presence in right now. And they have a tremendous amount of cash, be a great opportunity to use it, and it would add to the portfolio of other areas that they're in. So I look at it as a positive. Hopefully it'll go through for Microsoft, and they'll be able to pick up that TikTok app, U.S. operations, and that'll just be another feather in their cap in terms of growth going forward.
All right, Dan Morgan of Synovus Trust. Thank you so much, Dan, for joining us to weigh in on this Friday. Appreciate your insights and have a wonderful weekend. All right, coming up, we're going to talk more big tech and take a closer look at the one company we didn't mention just there, and that is Amazon, with huge Q2 numbers that surged past expectations, what the demand in e-commerce means for the tech giant, and can Amazon keep up? This is Bloomberg. Amazon out with its second quarter results yesterday, and it was a humongous quarter, showing signs of life that the company can make money. In fact, much greater profits than most expected, despite spending heavily to keep operating through the pandemic. I want to bring in Melissa Burdick, co-founder and president of PackView, a company that helps other companies manage their marketing strategies. She also worked for Amazon for 10 years and helped launch its advertising business. So, Melissa, thank you so much for joining us. Great to have you. Obviously, would love to hear your high-level takeaways from Amazon's results. This is a company that quarter after quarter we haven't seen big profits from, despite how much money they make. What's your take on the fact that they've been able to eke out these billions of dollars despite continuing to spend heavily?
Yeah, it's pretty insane. It was their largest quarterly profit in their 26-year history. And frankly, I was kind of surprised because when COVID hit, they really prioritized essentials business, like hand sanitizer and toilet paper. Their grocery business grew, and those are very unprofitable businesses to Amazon. So, but they sold a whole lot of stuff. And on Brian Oslowski's call yesterday, he said that, a third of it came from a reduction in marketing. And so they did stop spending on Google search for 12 weeks. They also stopped paying out affiliates as well to kind of throttle so much demand that they were having. Another thing that they talked about was that the 3P business grew faster than the 1P business. And the 3P business is a much more profitable business to Amazon. And then lastly, AWS, of course, is very profitable to them as well. The other bucket, which is usually advertising, that grew 41%, which is really what is in line with the advertising data that we're seeing from our clients as well. So we saw actually that take a little bit of a dip, either in April or May, depending on where clients were in their life cycle having inventory. But it was really driven by inventory out of stock, any kind of dip in advertising, but back into it in June and continued growth from there.
I want to talk to you about the rise of Amazon's own advertising business. Google and the CEO of Alphabet, Sundar Pichai, made the point in the antitrust hearing to talk about how, Amazon is a competitive threat in the advertising business. It is rapidly encroaching on Facebook and Google, which are the leaders in the digital ad market. How quickly do you think Amazon can catch up to them?
I mean, their share is still pretty small. I mean, it is eating into Google share. And then, also product searches, most product searches are starting on Amazon, not Google. So in a recent survey that I saw, it was 49% of product searches start on Amazon and 22% start on Google. Their market share, Google's, you'll see they're declining. Amazon's is increasing, but it's still a small percentage, which means that there is a lot of opportunity and room.
And last question, because Amazon, obviously some interesting highlights that they were able to triple their grocery orders, but also that they're running out of space. People are ordering so much, they don't have a place to put all of it. How does Amazon confront that challenge?
That to me was the biggest kind of big challenge to brands and sellers. Running out of space is not a good thing. And so what we saw when COVID hit and they had no capacity, so they weren't able to plan for it. COVID was like every day was Prime Day without being able to plan for it. So what that means is, brands are going to have to scramble to have, drop ship capabilities. They're going to have to create hybrid accounts. They're going to have, sellers may not have FBA space for them to ship into. So a lot of brands and sellers are going to need to have alternative means to get their products into Amazon. And then also one of the things that brand manufacturers are doing right now is SKU rationalization. Maybe they're not going to have every, size and color available on Amazon like they normally do, but looking to just selling more of their top tier, units and SKUs.
So last quick question, I lied, Melissa, is I have to ask you about Jeff Bezos' performance at the antitrust hearing. He was actually backed into a corner more than I expected, and he didn't have some of the answers that lawmakers wanted. Quickly, what did you think about how he showed up? I think that he had good answers, and he kind of deflected by saying, I'll look into it, and didn't have the exact answers that people were looking for. But, I think the hearings will continue. It'll be a thorn in his side for a while, but, I don't know if investors really care. All right. Well, Melissa Burdick, thank you so much for joining us and sharing your perspective on all of that here. Great to have you here on the show, especially given your inside knowledge of the workings at Amazon. Thank you so much for joining us. I do want to get to some quick breaking news. James Murdoch has resigned from the board of News Corp, of course, a family company that his father founded. Effective immediately, James Murdoch has resigned from the board of News Corp over quote unquote disagreements over certain editorial content published by the company's news outlets and other strategic decisions. We're going to continue to dig into this. We're looking at the letter that Mr. Murdoch provided to the board of directors about his resignation, and we'll bring you more highlights as we have them. Coming up, we're going to be talking more about TikTok and Microsoft and Twitter, the big hack, and who's behind it. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Back to TikTok. Earlier, we discussed the president's executive order that ByteDance, the Chinese parent company, divest its U.S. ownership of the social media sensation. Now, Microsoft is said to be in talks to buy TikTok's operations in the United States. Also this afternoon, we're hearing of arrests that have been made related to the recent Twitter hack of prominent tech leaders and politicians. With details on all these stories, I want to get to Bloomberg's Kurt Wagner. Kurt, let's talk about the Twitter hack first. There are 3 people who are now alleged to have been a part of this operation, including a 17-year-old who just graduated from high school. Tell us what we know.
Yeah, the 17-year-old who was arrested today is a Florida resident. I believe he lives in Tampa, and he is being charged with something, I believe, 30 different felony charges for what he and a few other people did, which was, as we now know, gain access to a handful of very prominent Twitter accounts. And so this is, just the latest kind of detail to come out of that investigation. Twitter actually said last night that part of what happened was that employees were actually due to handing over some information and credentials via phone calls. So we're kind of slowly learning bits and bits about how this all came together. But yes, the arrest of a 17-year-old today is the latest news on that front.
17-year-old Graham Ivan Clark. What does it say about Twitter's security if a 17-year-old, who had just graduated from high school was able to compromise this platform in such a massive and high-profile way?
Well, it's obviously a problem, and we actually had a story earlier this week that included the phone call detail, which I think is important because it just goes to show you that this was not just a technical hack. This was social engineering as well. This was a very advanced way of not only getting into Twitter systems, but then taking advantage of those systems once they were inside. The company has said that they have cut back on how many employees actually have access to some of these systems that could reset passwords while they're doing this investigation. Our story from Monday said that there were more than 1,000 employees and contractors at the company who had that kind of access. So this is clearly something that's a major red flag. And as we head into an election season, it's something that we certainly would hope Twitter is going to clear up very, very quickly.
Now, I'm so curious about this TikTok news that you have been following with Microsoft in talks to buy TikTok's U.S. operations. How exactly would that work if Microsoft just bought the U.S. part of a company that is an app used by millions of people around the world?
Yeah, it's incredibly complicated, and I think you're asking the same questions that we are asking. I think the important thing to remember here is that TikTok is basically broken up into two apps. There is Douyin, which is the TikTok version that's available in China, and then there's TikTok, which is available in many of the Western countries, and I believe include India. And so what we've seen is that they have tried to delineate between those two services, even though they're very much the same product, to say that one of them is kind of contained to within China and the other one is outside of that. So it's unclear if this would be Microsoft buying kind of everything outside of China, or if there would then have to be a third version of TikTok, kind of a version that Microsoft buys, a version for the rest of the world, and then a version in China. It's incredibly complicated, as you're pointing out, and I think those are still questions we're waiting to have answered.
Meantime, the president has made his intentions, or his feelings, I should say, clear. How that translates into action, we don't necessarily know. Earlier today, he said, we're looking at TikTok. We may be banning TikTok. We're looking at a lot of alternatives with respect to TikTok. What do you think he means by that?
Well, as our story today points out, there was the expectation that he was going to come out and say, hey, you have to divest this ownership in the app. I think that would actually solve the banning problem, because if ByteDance were to sell off the U.S. version of TikTok, especially to a company like a Microsoft, a U.S.-based company, it would kind of alleviate the need for Trump to do anything like a ban, right? Because suddenly the data would be contained here to a company in the United States. So as we know from a lot of the statements that he makes, sometimes it takes a couple days to parse through exactly what he means. In this case, the fact that Microsoft is actually in talks with TikTok, I think, is a sign that everyone's taking it a lot more seriously than probably we had thought even just a couple weeks ago.
All right, Bloomberg's Kurt Wagner. I know you'll continue to follow that story, and we will be watching your reporting. Thank you so much for that update. Moving on now. Apple's playing field is the most uneven in the history of technology. This is according to the CEO of Epic Games, the maker of Fortnite, Tim Sweeney. We talked to Sweeney earlier this week about his concerns about Apple and Google as a duopoly, as he called it, as well as what Epic is doing to create what they hope to be fairer software practices around the world. Take a listen.
Well, first of all, we tried for about 3 years to have meetings with Apple's senior executive team, made a dozen requests or so, and they always turned us down. And so ultimately, I sent them a letter asking for exactly the right to process our own payments in Fortnite and the right to launch an Epic Games store, both through the iOS App Store and installable directly by users. And ultimately, they had a lawyer send us a letter saying no. I admire their forthrightness for giving us an answer, but that's in no way an acceptable situation for a platform for 1 billion users. You can compare it to a game console, but a smartphone and a computer are really unique. These are devices people use to conduct a large part of their lives and a large part of their business. In some cases, their entire business. And you can't have a tech monopoly dominating all interactions between consumers and businesses on a scale of billions of users. It just creates the same sorts of concentration of power problems as the railroads, right? And the early trust busters, fought the railroads over similar practices of tying services together, saying if you want to use our railroad, well, you're not allowed to ship oil because we're in the oil business, and so you can build your own, and these are disingenuous arguments that are aimed at supporting unfair business practices.
Now, here's what the companies are saying. Google says it's maintained and committed to operating in an open and principled way. Apple has said the complaints about the App Store are baseless from a handful of companies who simply want a free ride, don't want to play by the same rules as everyone else. We, Apple says, want to maintain a level playing field where anyone with determination and a great idea can succeed. What's your response to that?
Well, I think Google is in a better position than Apple. Google does have a semi-open platform where users can install software from means of their choice, but they use their agreements with OEMs and carriers to prevent actual competition. So that's our problem with Google. Apple is being entirely disingenuous. For example, every time we've communicated with Apple about our desire for an open platform and freedom to process our own payments, we've said, we want this for the whole industry, not just for ourselves. And Epic does not want a special deal from Apple. We don't want a special deal from Google. We want wholesale policy changes affecting all developers, which free the software economy for everyone. And Apple's playing field is the most uneven in the history of technology products. The advantages Apple gives itself through its control of the operating system, and they have rules that outright say you cannot build software that competes with categories of Apple apps, which we view as key to our platform, right? This playing field between Apple Music and Spotify is completely uneven. Apple Apple receives 100% of their revenue from their music service, and then they can use that to pay out artists. Spotify only gets 70%. So in negotiating terms with artists, Apple is in a 30% better position than Spotify. And it completely distorts the economy of apps.
So what do you want Apple to change?
Well, there are really two things. First of all, unbundling all of the services from each other. The software distribution service should be unbundled from the store so that you can install software from the web or from any other source. The payment service should be unbundled or untied from the store itself so that developers can use any payment provider they want. And totally support Apple's right to compete as a payment provider and offer their services and make their services as competitive as possible. Just, they can't exclude all of their competition from that. And so these two things. Number one, make iOS and Android real open platforms where anybody can install software, and the software users install from other sources can operate on par with Apple and Google's own software. And number two, unbundle all of these services that are currently tied into a store, a distribution service, a payment processor, and everything else. Then you'd have a level playing field for everybody that's actually level.
Do you think Apple and Google should be broken up?
I think that's, I think they should fix their policies and practices. And I think we should let the market speak for itself. Breaking a company up is the kind of the ultimate solution to a company that refuses to follow the laws and implement fair business practices. I would certainly hope that cooler heads prevail and that Apple and Google, instead of going through the process Microsoft went through, where Microsoft lost a decade fighting this antitrust case and then playing this passive-aggressive game with their customers, with their suppliers, with the governments of the world to try to obstruct the settlement that was reached. I wish Apple and Google would just change their policies, and I wish they'd just free their engineers. Apple engineers know that the security of iOS comes from the fact that they have the best operating system kernel in the world and the best permissions-based security model in the world. The Apple engineers know they do not need a monopoly on software distribution to protect their users from malware. And if we just were to empower the engineers to make more of these decisions and stop the business guys from obstructing it all, I think the tech industry could solve this problem this year. By the end of 2020, we could have Google Android truly open to competing stores and iOS truly open to competing stores and all the payment stuff unbundled. And I think all companies would benefit. Apple and Google wouldn't lose the next decade fighting all the governments of the world in antitrust. And ultimately, I think their services would be better from competition. Look at Microsoft now versus the crappy version of Microsoft that existed a couple of years after the antitrust settlement. It's a far better company. It's a much more valuable company for shareholders. And most importantly, it's a fair company.
Tim Sweeney, the CEO of Epic Games there. Coming up, the likelihood of Major League Baseball playing a full season has dwindled with each passing day. What does it mean for the online world of sports betting? We'll talk to the CEO of FanDuel next. This is Bloomberg. While the NBA returned to action last night, Major League Baseball has continued to run into roadblocks. COVID-19 outbreaks among two Major League Baseball teams, the Miami Marlins and the St. Louis Cardinals, have led to more game cancellations. Joining us now to discuss what this all means for sports and the world of online sports betting is the CEO of FanDuel, Matthew King. Matthew, thank you so much for joining us. So this has been very disappointing for my sons, I should add. What's your take on how this plays out?
Look, I think these types of issues in baseball were inevitable. I think when you think about the logistics that they have of traveling, the number of games, the frequency of games, stuff like this was bound to come up. It's all about how they handle it. I think, there's a lot of people working very hard to figure out how to make it safe. I'm an optimist that they'll still figure it out, but it's probably going to mean tightening down on some of the restrictions and protocols that they've put in place and going a step further than they've gone already. And so I think they'll figure it out, but there'll be some bumps in the road.
So how is this impacting your business and the world of online sports betting, the delayed return of sports in general?
So from our perspective, the business has actually performed really well. We have the broadest variety of sports and products that people can play. That's meant that our business has held up really, really well during this whole period. That said, people like certainty, right? I think you're going to see people that are sad if baseball gets disrupted. But at the end of the day, there's always things that people can watch. There's plenty of European sports back. There's obviously the NBA, and we do think the NFL will play. So there will always be something for somebody to do on one of our sites.
As you just said, basketball restarted last night in Orlando, and they're taking a different approach than baseball. What kind of activity did you see on your platform compared to normal times?
It was the biggest night of NBA that we've ever had. Most number of users, most amount of handles. So demand was off the charts.
So how do you expect that to play out, given that there's probably some pent-up demand here, right?
Yeah, I think there's pent-up demand, but I think at the end of the day, it's been pent up for 4 or 5 months. And so I think you're going to see a really busy August that rolls right into NFL kicking off. I think you're going to obviously have a lot less college sports, and college is a huge part of that business. And so I think you'll see that down, but I think you'll see sports like the NBA and NHL offset that loss.
Meantime, the Massachusetts Senate this week dropped a big sports betting component from an economic development bill that I know you've been following closely. How optimistic, I know you said you're an optimist, how optimistic are you about online sports getting legalized in Massachusetts and the rest of the country?
We're very optimistic. I think even pre-COVID, what you started to see through New Jersey and Pennsylvania was a very clear acceptance that legalizing sports betting was just common sense legislation. To have a competitive mobile marketplace protected consumers, raised tax revenues, and gave constituents something that they wanted to do. And so we were seeing momentum even pre-COVID, and we think that will accelerate coming out of COVID. You will certainly see states like Massachusetts where idiosyncratic factors may create bumps in the road in terms of the law getting done. It may create delays, but when you look in aggregate, we think you're going to see a lot more states passing online sports betting and, frankly, online gaming too.
How are your customers evolving in the pandemic? Are you seeing new kinds of people, given that, other outlets may not be available to them in terms of entertainment?
We have seen some retail shift. So in our online casino business and our online horse racing business, both of those verticals have a big chunk of the market that's done at retail and brick and mortar. And when those closed down, we saw a big chunk of kind of retail first customers show up. And even as retail is reopening, we're keeping a lot of that business as well.
So how is FanDuel evolving its strategy to meet new kinds of demand, if you will, in the midst of continued uncertainty? Look, the virus is resurging across the United States, in different places around the world. And if there's one thing we know about the next 6 months, it's that we don't know what those months are going to hold.
Yeah, I mean, a lot of what we're doing is just trying to expand our product offering. I've been really proud of the creativity of the team. And a lot of that creativity has come in the form of free-to-play games. The beauty of free-to-play is you can spin them up quickly. You have a lot more latitude in terms of what you can do. And the mission that we've given our team is really just keep people engaged and give them something to do during what's a period where, as you correctly note, there's not a lot to do or not a lot of other forms of entertainment. And so our biggest focus has been on expanding our product offering to make sure that we can account for any eventuality.
So what kind of new products are you talking about or thinking about?
So we've done everything from, in the depths of the pandemic when there was, almost no sport on, we were doing a lot around esports. And that was a lot of fantasy esports. And then we were also doing a lot of free-to-play games, even around kind of simulated, NFL seasons or MLB games where literally people were building a fantasy lineup based on historic simulations. And so, again, it was just all about creating a way for people to be entertained.
Quickly, do you imagine that the sports business will be forever changed by this? And if so, how?
I think the biggest impact on the sports business is probably going to be, one, I think the return to stadiums and full stadiums will just take time, not because necessarily for public health reasons, but I think people, there will be a chunk of people that are uncomfortable in crowded spaces. And so I think you'll see challenges around attendance for probably a prolonged period. And then I think probably the biggest issue is the acceleration in cord cutting that's occurring during COVID, I think is going to change how people consume sports. You're going to see a lot more streaming of sports and a lot more changes in kind of how people consume sports media. And I think that'll probably be the most lasting change.
Interesting. All right. We'll be following all of that. FanDuel CEO Matthew King. Matthew, thanks so much for joining us. Good to have you back here on the show. All right, coming up, a month after China's sweeping security law, what is happening in Hong Kong? We will take a look next. This is Bloomberg. And finally, this hour, we turn to a developing story out of Hong Kong, where there is growing opposition to Hong Kong Chief Executive Carrie Lam's latest announcement that the September Legislative Council election will be delayed by a year because of the pandemic. With more, Bloomberg's chief North Asia correspondent, Stephen Engel.
Hong Kong Chief Executive Carrie Lam says she ordered September's Legislative Council elections postponed for 1 year. That in order to ensure public safety amid a third wave of coronavirus outbreak. We had 121 new cases Friday on top of a record surge on Thursday. The opposition pro-democracy candidates for those Legislative Council elections, though, they're not buying the reasoning. They say the delay is intended to rob pro-democracy candidates of momentum after, of course, the implementation of that highly controversial national security law a month ago. Now, the postponement follows the disqualification of 12 pro-democracy candidates and the arrest as well the day before that of some 4 people who were accused by Hong Kong authorities of promoting self-determination for Hong Kong on the internet. It caps a week of new red lines being set out by the Hong Kong government on the level of dissent that they will allow. Stephen Engel, Bloomberg News, Hong Kong.
And be sure to catch Bloomberg Television's 1-hour special, Hong Kong on Edge 2, 7 p.m. tonight in New York, airing again throughout the weekend. And I do want to tell you again about those headlines out of News Corp. James Murdoch, Rupert Murdoch's son and a one-time heir to the family media empire, has resigned from the board of News Corp, citing disagreements over editorial content and other strategic decisions. Of course, News Corp owns Fox News and the Wall Street Journal, among other outlets. That's the latest. This is Bloomberg.